All right, let's get right into it. Thursday morning, January 8th. The implied open is mixed.
Very mixed. You're seeing the S&P futures, the ES, they're ticking up maybe 0.2%.
But the Nasdaq is the story. The NQ is lagging down about 0.3%.
And that really defines the morning. We are deep in this post-holiday holding pattern. Sentiment is strictly neutral. It feels like everyone's just waiting for a real catalyst.
Well, we have two of them, and they're pulling in completely different directions. First, you've got geopolitics, the White House move on Venezuelan oil that's injecting a lot of volatility into energy.
That's the global piece. And then you have the domestic driver, which is the labor data. Everyone is laser focused on the 8:30 a.m. initial jobless claims.
Right. Consensus is what, 213,000?
213. And any real deviation there is going to tell us if this weird no hire, no fire environment is finally starting to crack.
Which brings us to the core conflict. The big question you need to be asking yourself right now. We see corporate productivity just soaring, presumably from AI.
Off the charts.
But hiring is completely stalled. So is this market driven by real sustainable earnings, or is it just an AI-fueled fever dream?
That distinction is everything. Let's look under the hood and see where the actual money is moving this morning.
Okay, let's start with the micro. The pre-market movers are telling a few different stories.
Three very distinct narratives. You've got defense, you've got AI disruption, and you have energy safety. They're all basically hedges.
Let's start with Intel, INTC. It's actually outperforming in the pre-market, bucking that Nasdaq weakness. Is this CES chip reveal the real deal?
Well, the why here is that Intel is finally showing some teeth. They're providing, tangible evidence that they can defend their silicon moat.
So it's not just promises anymore.
Exactly. They're demonstrating the architecture for edge computing for AI on consumer devices. The market's voting that the AI wave isn't just for the hyperscalers.
Okay, so Intel is the proof point for real productivity. Now let's contrast that with Tesla. TSLA is slumping, what, 3% pre-market?
And it's not just general tech malaise. The move is surgical.
Because of Nvidia.
Because of Nvidia's Alpamayo autonomous platform, the street is seeing that as a credible, I would even say existential threat to the Robotaxi narrative.
Which is the highest multiple part of the story.
It's the whole story for that valuation. When a competitor with Nvidia's power looks like it's closing the gap, you get a very sharp repricing. It shows how fragile some of these narratives are.
Classic disruption. Okay, now let's pivot to the complete opposite. Old economy. Valero, VLO, is trading at all-time highs.
And this connects right back to the geopolitical catalyst we started with.
The Venezuelan oil situation.
Right. Valero, the domestic refiners, they are the flight to safety play. When the U.S. government resets the crude supply chain in Latin America, these guys benefit from the volatility. It's a pure macro hedge.
So we have three stories. Intel defending, Tesla being disrupted, and Valero is a safe harbor. If we zoom out, is there any structural strength anywhere?
You know what's fascinating? The only sector showing any kind of consistent structural strength is aerospace and defense.
The geopolitical hedge.
It's the most reliable one. And the fact that it's holding up while the broader market has basically zero conviction tells you where institutional players are keeping their risk overlay.
Okay, let's use that weakness as our transition then. Let's move from the specific stocks to the overall market structure. Time to define the lines in the sand for today.
Perfect. Because we are not trending. We are consolidating. The market is trapped between, technical exhaustion from the year-end run and this institutional rebalancing.
So looking at the S&P, the ES, what's the vibe?
The vibe is filling the gap. Sellers are defending the psychological ceilings, but you're seeing dip buyers show up on any weakness.
So give us the map. Where's the critical inflection point for the S&P today?
59.45. That is the number.
Okay, 59.45.
If we hold above it, bulls have a shot at a slow grind up to 59.80. But, and this is a big but, if we break below 59.45, the momentum shifts instantly. It's a fast trip down to 59.10.
And 59.10 is that high volume node support you mentioned. So what's the strategic takeaway being stuck between those two levels?
We are in a classic liquidity trap. The price action is just ping-ponging. The instruction from the desk is simple. Do not chase the middle.
Play the edges or stay out.
Play the edges or stay flat. You buy 59.10, you sell 59.80. Anything in between is just noise until we get that catalyst.
Now let's apply that to the Nasdaq 100, the NQ, because it's showing that relative weakness. That's a concern.
That's a concern. We're seeing clear signs of what we call stealth distribution in big tech.
Meaning institutions are selling into strength quietly.
Exactly. Taking profits without causing a panic. The semis, which were the leaders, they are definitely cooling off. That relative weakness is a serious warning sign.
So if 5945 is the S&P's number, what's the line in the sand for the Nasdaq?
For the NQ, it's 21,150. That's the hard boundary.
And what's the big signal from the overnight session?
The failure. The Nasdaq tried to clear 21,300 overnight, and it just failed to hold. That is a textbook false breakout scenario.
So how do we know that wasn't just a retest? What's the evidence it's a real false breakout?
The volume on that rejection, it was significant. It tells you real supply came into the market there. And a false breakout usually means the market is about to turn around and hurt the people who bought the top.
So what's the warning here?
The warning is to watch for a stop run, a targeted flush below 21,000.
Just to clean out the weak longs.
Exactly. Before any real move higher can even be considered, if you are long tech and you're not hedged, 21,000 is where they will test your resolve.
That's crystal clear.
Yeah.
Okay, one last pivot. Let's talk about the macro headwind. This is the risk that so many people miss when they're just chasing tickers. This is the duration trap.
This is where it all connects back to the bond market. You have to look at the macro dashboard, the 10-year yield, the UST 10Y, and the dollar index, the DXY.
Okay, starting with yields. The 10-year has backed off its high. It's down to what, 4.15% from 4.2?
It is, and that's providing a little breather for tech.
A temporary one.
Oh, absolutely temporary. Lower yields help the math on future earnings, so big tech gets a moment of relief. But the underlying pressure for rates to move higher hasn't gone anywhere.
And the dollar. The DXY is consolidating at 98.74.
Which is a crucial level. It's basically setting a ceiling on the market. It's not strong enough to crush everything, but it's high enough to prevent any massive breakout in risk assets. The dollar is putting a lid on the party.
So, temporary yield relief plus a low market ceiling.
Yeah.
That sounds like the setup for the rotation trap.
It is. Institutional money is broadening out. Capital is leaking out of the magnificent laggards and flowing into quieter spaces.
Like mid-cap industrials, materials.
Exactly. And the warning here is stark. If you're just buying the dip in those same mega-cap names from last year, you are fighting the tape. Institutions are moving on.
Okay, so that's the first layer of pain. What's the ultimate pain trade here, the one that retail is most exposed to?
That's the duration trap. And it gets triggered if the 10-year spikes back towards, say, 4.35%.
Which is JP Morgan's target, so it's not some crazy scenario.
Not at all. And what retail investors often miss is that they are, by default, positioned in long-duration assets, growth stocks that need low rates to justify their PE ratios.
So a yield spike isn't just a small adjustment.
It's a violent, wholesale repricing of the entire sector. The cost of capital changes everything, and the exit door gets very crowded, very fast.
And the pain trade is watching your tech bleed while the boring stuff rallies.
That's the whiplash. It's watching your unhedged tech portfolio get hammered while energy and financials are hitting new all-time highs. That double hit is where the real pain lives.
That is exactly the clarity we needed. So to summarize, we're in a state of mean reversion, trapped between key levels, fighting this conflict between the AI fever dream and the need for real earnings.
And the key warning is this. Do not mistake this little yield breather for a trend reversal. This relief is fragile.
And timing is everything today, right? We've got jobless claims coming up.
Absolutely. And remember, Thursdays in January often have these window dressing reversals. If our key levels, 59.45 in the S&P, 21,150 in the Nasdaq, if they break by the European close around 11:30 a.m. Eastern,
Prepare for a late day flush.
prepare for the momentum traders to pile on.
So you watch the price, but you watch one thing even closer.
You always watch the volume. Volume precedes price. If you see volume spike on a move below one of those pivots, the trap has sprung. You have to respect the tape immediately.
That's the playbook. But let me leave you with a final thought, building on this whole productivity versus labor thing. If this trend holds, if AI allows productivity to soar without new hiring, how do our long-term valuation models have to change?
It's the ultimate question.
If labor costs are permanently optimized away for certain sectors, the entire value hierarchy of the market could get completely inverted over the next 5 years. That's the real puzzle you need to be thinking about.
The ultimate disruption. Stay flat, play the edges, and stay sharp out there.